Hello, no mai, hoki mai, and welcome back to day 2 of the Financial Services Council 2020 conference, Generations. We hope you've had a relaxing break following our morning of commerce insights and expert analysis of the future of retirement and economy. It was great to see such robust discussions and debate in the regulatory space. And it's a privilege to actually have the wisdom and insights shared so close to us making our voting decisions. Knowledge is power. And wow, what an unforgettable closing session Dr. Susie Wiles delivered. She has proven the value in database decision making. There is no running away from the truth of science. And her ability to demystify the most complex subjects like microbiology is a testament to her passion for the subject. Well, it's not over yet. For the next hour, our breakout sessions are brimming with expert knowledge from right across the sector. Our curated panels of industry leaders weigh in on the power of data in insurance and the potential silver linings for the investment world in a post-COVID economy. Our Generations and Trustees sessions will look at the future and discuss what is needed for the sector to not just thrive but to survive beyond 2020, and also analyse what the future of New Zealand's team of 5 million plus will look like. Thank you again to our sponsors for supporting these sundowner sessions. Once again, in all sessions, there's an opportunity for questions and answers, so take note and enjoy. Mā te wā.
Hello everyone and welcome to this afternoon's session, which is Trustees and Supervisors Meet the Leaders. We're going to discuss the Supervisor's role in 2020 and beyond. Supervisors have a key role to play in the development of New Zealand's financial markets. And today we're lucky enough to be joined by the leaders of New Zealand's 3 big trustee corporations: Harry Koprivcic, CEO of Guardian Trust; Glenys Talivai, CEO of Public Trust; and Ryan Bessemer, CEO of Trustees Executors. We're going to discuss the Supervisor's function, how it has changed, and what's on the horizon. I'd like to encourage this to be an interactive session. I'm sure you are all now very familiar with the system and how you ask questions, but there's a little box right next to the live video. I'll watch out for questions coming through over the course of the session. There'll also be some time at the end for further questions. By way of background, and as many of you will be aware, supervisors are licensed by the Financial Markets Authority under the Financial Markets Supervisors Act. Supervisors are required to be independent of the financial institutions and the issuers that they supervise. For managed investment schemes, the supervisor actively supervises the manager's performance of its functions and its issuer obligations under the Financial Markets Conduct Act and the associated regulations. The supervisor acts on behalf of scheme participants in relation to the manager and the governing documents and the performance of the manager's issuer obligations. The manager's functions and issuer obligations include offering and issuing the financial product, managing the scheme property, administering the scheme, and managing the financial position of both the manager and the scheme. The assets of managed investment schemes are held in the name of the supervisor or its nominee on trust for the benefit of scheme participants. Where a nominee is used, that is an entity owned by the supervisor, specifically created to hold the assets of the relevant scheme. The assets are kept separate from the assets and liabilities of the manager and of the supervisor. This means that the supervisor holds the legal title to the assets for the benefit of scheme members. Other than in relation to custody, the supervisor is not permitted to delegate any of its functions to third parties. Supervision is undertaken through the lens of the investor, and supervisors use a variety of monitoring tools to monitor whether the manager is meeting its obligations under the FMCA, the scheme's governing document, and the offering documents such as the product disclosure statement. Monitoring tools include regular reporting and cross-checking, meetings, deep dives, and thematic assessments. The monitoring process allows the supervisor to develop a very close understanding of how their supervised entities operate. The supervisor will assess the robustness of the processes, procedures, and controls that managers have in place, and whether those controls are adequate in order to comply with the duties and requirements, and to ensure that good customer outcomes are achieved. The supervisor monitors managers on an ongoing basis and ensures that any actual or potential non-compliance that may adversely impact on scheme participants has been appropriately addressed in a timely manner. Further, with their depth and breadth of knowledge across their appointments, supervisors are well placed to assess the operations of a manager and the robustness of a manager's processes, procedures, and controls to ensure that good customer outcomes are achieved. The FMA is not involved in detailed day-to-day supervision of managed investment scheme managers or their particular products. Instead, the FMA's focus is on monitoring supervisors to ensure that they meet their legal obligations. Supervisors must report to the FMA if a material contravention or a possible material contravention of an issuer's obligation has occurred or is likely to occur. They must advise the FMA of the managers and the supervisors' plans to respond to such a contravention, and they must also monitor the implementation and effectiveness of any proposed remedial action. New Zealand's supervisory model is a unique one, not seen elsewhere in the world. Ryan, you have experience working in an Australian trustee company from your days at Equity Trustees. How does the New Zealand model compare to other jurisdictions, especially Australia, which has a single responsible entity?
So, Penny, as you mentioned before, the supervisor model is at the moment in New Zealand is really where the supervisor is effectively the front sort of end regulator in this environment, where as opposed to other environments, the trustee or in the case of Australia, the responsible entity is really just a monitoring tool. And in many cases, that monitoring tool is a tool that's really run by the company themselves. So a fund manager would have their own trustee company, and that trustee company would own the license, the trustee license, and effectively monitor themselves as a separate board or entity. Where in New Zealand you have to have a independent trustee function called the supervisor, and it becomes more complicated. And New Zealand's really one of those places where the concept of the supervisor is unique, but it's also a really simplified and quite dynamic type of function. As an example, in Australia, you have ASIC, which looks after banks, or ASIC looks after companies and managed investment schemes. You have APRA that looks after banks, insurance, and superannuation, and you have AUSTRAC that looks after AML. Where in New Zealand you have really one regulator that does it all, and then you have this function, this first line regulator called the supervisor, that really has that really unique and detailed knowledge of each of the fund managers or each of the participants. And as you know, the supervisor does more than just manage investment schemes and KiwiSavers, but there's also other types of products and services that we offer. Where a trustee in other jurisdictions, particularly the responsible entity in Australia, will be looking at disclosure documents or mandates, or what we call SIPOs, compliance controls and so forth, but there's no direct reporting through to the regulator, where the manager reports through the regulator. Where in New Zealand, as a supervisor, we directly report to the regulator on every single one of those managers. So it's actually a simplified focus, and I think the Financial Markets Conduct Act is really a conduct and culture focused piece of law. In other jurisdictions, it's not nearly as clear. There's multiple acts, and many of them very old, and regulation can be somewhat difficult to understand. As an example, the difference between managed investment schemes and Australian superannuation is very different, although the products are very similar, because one's regulated by one authority and one's by another authority. So there's not even any standards across managing different types of managed funds. So it becomes quite difficult to deal with, and particularly you've got two regulators with very different focuses. It's great in the market here to have the one regulator, the one focus, and the one supervisor that takes care of you.
Thanks, Ryan. And you've touched on this a little bit, but what do you think the key real benefits of our model are?
I think really it's the one and one regulator, and one regulator that's very involved in the industry. I think also there's much more of ability in New Zealand to not only talk to the regulator, but also talk to the government and the politicians about the industry as well, where in other larger countries it's just not possible. I think from a supervision point of view, the supervisor, it's our role is not only one of just that frontline regulation, but it's also one where the supervisor, where we can give guidance to our clients or guidance to the managers as well. So it's not just a slap on the back of the hand with a ruler type of relationship. It's something where you've got that understanding of their business, how they operate, and that deeper relationship there to really truly understand the risks of each of the managers that operate.
Glenys, can you tell us more about how the role of the supervisor fits in with other roles, such as those of the manager and the FMA as regulator?
Yeah, thanks, Penny. So, as you said earlier, as supervisors, our responsibility is first and foremost to the scheme participant or investor. And so we're always working with their best interests in mind, even though it is the manager who appoints us. So there needs to be a level of, I suppose, what you might call professional skepticism or tension between the supervisor and the manager, recognising that as supervisors, we must independently assess whether the information provided or the processes in place meet the manager's obligations to those scheme participants. And for managers, that is a core part of their role, is really they are offering products and services for managers, for scheme participants, and that interplay with the supervisor really is us making sure that they're doing that in a way that is complying with all of the things that they need to comply with, and in a way that is in the best interests of those investors. Now, as mentioned earlier, also any material contravention or possible or likely contravention of issuer obligations by the manager are reported to the FMA, and supervisors are required to outline the actions that the manager and the supervisor intend to undertake to remedy that contravention. And so, I think an important delineation between the supervisor and the FMA is that the supervisor will recommend actions with the manager, but if the FMA is not satisfied that the proposed remedial action ensures that investors are fairly remediated, then they have the ability to intervene and instruct the manager and the supervisor to undertake further action as the regulator. So, as supervisors, we're not the regulator. We work, as a layer in between the manager and the regulator to really ensure that the right things are happening. And that ensures that the FMAs are kept abreast of material issues at a more granular level that would enable it to quickly become aware of any developing trends across the industry, or if there's any potential wider industry issues that may need to be addressed. And they do that through their ongoing monitoring of supervisors, which, similar to what we do with managers, FMA conducts site visits with supervisors to make sure that we're appropriately thinking about our obligations to investors. So I think, what's quite important here is that this New Zealand regime requires both the FMA and licensed supervisors to work closely together and share information. And There's some good examples of that. But equally too, down with the supervisor to manager is that, we're getting very close to that manager's business to help them improve processes, ensure that they're thinking about conduct outcomes, always with those investors and scheme participants in mind. So it's an interesting layered model in terms of the different obligations that each of those entities have.
And Harry, how do you think the role of supervisor is perceived? Is it a quasi-regulator or is it a service provider?
Thank you, Penny. Look, I agree what Glenys and Ryan have mentioned in terms of the differences in the model and also the role of the supervisor. I'll just maybe add a couple of things, and that is that the one big important difference that we see as well is in other compared to our jurisdiction is independence. It is very important compared to our model. We have that independence in New Zealand. We are not a related entity. But supervisors could be perceived sometimes to be some quasi-regulator or a service providers, but we are not. And as Glenys mentioned, we have our own fiduciary and statutory duties to those investors. Now we work closely with the FMA to assess to inform the FMA of any material issues that might come at either granular level or either more sector levels, and that enables FMA to assess any developing trends or undertake thematic reviews where they think in areas of the sector that need to be undertaken. Now, we are not also service providers for the managers. We do work with the managers very closely. We understand their processes, understand their controls to ensure the best outcomes for the investors are achieved and they comply with their material obligations. But we are not their service providers. We are there for investors, and we are effectively appointed by the investors to perform those duties.
So who do you see as your client or customer? Is it the investors, as you've indicated, or is it managers? They have an aspect of being your client as well?
Yeah, that's it's an interesting question, Penny. I think it is our primary duty and objective is to ensure that investors' interests are protected and that the supervised entities are complying with with their obligations in all respects. Now, we do believe that through our robust and through proactive supervision, there will also be a benefit for the managers as well, because we will be lifting the standards across the industry, and by doing that, we will also be enhancing investors' overall confidence, and that will benefit the managers because their investors will tend to invest in those products offered by the managers. So there is that natural alignment of interest that if the managers ensure and we supervisors ensure the managers comply, that customers, the best customers' outcomes are achieved, the manager will benefit as well, as so by the industry participants as well.
And speaking of alignment, Glenys, where do you see alignment between the manager's duties and the supervisor's duties?
Well, I think that, ultimately managers and supervisors are aligned in many ways, as we should be, because, we're both operating to obtain the best possible outcomes for investors or the scheme participants. And certainly I think that generally managers are very keen to ensure that they are carefully managing their risks, improving processes, improving their business, and meeting their legislative and regulatory requirements, which means that working with a supervisor should be relatively straightforward, given that dual objective. There's always, and there should be, some inherent tension because as a supervisor, we will be pushing managers to continue to refine their approach to get even better customer outcomes or investor outcomes. But I think there's a lot of alignment. I think generally, there's been a lot of new legislation and requirements that have been falling on the managers' shoulders. And, if they are engaging with their supervisors and conversely, so supervisors are engaging appropriately with managers, then we should have a robust working arrangement where actually, all of these things are just happening as a part of everyday business, because it's, ultimately leading to, as Harry said, better outcomes in terms of how they're running their business, and then ultimately the confidence that will give to investors in terms of those managers' products, particularly knowing that this robustness sits behind the scenes in terms of that protection. And I think it's even relevant, in recent times. So I think there's a lot of alignment, probably more so than what we'd imagine. I think it comes down to how supervisors and managers recognise that alignment and work together and get real clarity around where supervisors can really help managers to benefit their business.
Great. So we have our first question from the audience. Do you think that supervisors should be appointed by the FMA and not by managers? How do you stop managers from shopping for the cheapest and most lenient supervisor, as it is not in the investor's best interests?
I think that's it's a pretty tough question to ask to a bunch of supervisors, but I would say that we've got three very good quality supervisors here that are talking to you, and the FMA, I would say that they would be as if not more conflicted than any manager choosing choosing a supervisor. I think currently the way the model works is we need to prove our value, and I don't necessarily see that as a bad thing.
I think too, under the banner of the TCA, is that supervisors are committed to working together to ensure consistency across the industry, and I think that I think that there is some benefit for managers and ultimately end investors that managers do get to select a supervisor, to what Ryan said, to ensure that there's significant value add. But ultimately too is that, we do have an industry body as supervisors where we work together to ensure consistency, because there shouldn't be a huge amount of difference in terms of, I suppose, the end outcome or the standards set by supervisors. That shouldn't be drastically different. And the work that we do under the TCA is a testament to our commitment to ensuring some of that consistency.
Yes, I agree with what Brian and Glenys have mentioned, and obviously we are licensed by FMA, and we expect all to have certain standards, as are the managers, and their minimum standards, and we get and FMA monitors how we deliver that and how we supervise our supervised entities. But it is the manager that it's appointing the supervisor, but it is doing that for the best interest of the investors, and the manager in doing that does have to assess how that, what Glenys said, value add will be added by the supervisors, and how that value add and how they will interact with the supervisor. The standards are there in terms of supervision standards, but also, as Glenys said, as TCA, we do develop policies and practices and procedures that all supervisors follow. So the outcome for the investors should not be too dissimilar, as that it is our duty to act in their best interest, as is the managers.
And I think you'll see in time more of an active role the TCA will be playing in the relationship between the main supervisors in the industry. And I know we're all committed to be able to be working together to be able to improve and add value to the investors.
Thank you. And we have now two further questions from the audience. This is great. Thank you, everyone. Do you think that custodians should also be licensed?
I definitely think so. I mean, I don't know if that is something that is controversial as well, but I find it strange to be working in an industry where custodians are not licensed. And I think not only should they be licensed, but they should also have the appropriate capital backing and quality of balance sheet to be able to be custodians. I think it's such an important role where where money sort of leaves the bank account, and the custodian has a major responsibility. So I'd definitely like to see some further regulation being put around custodial licensing.
Yeah, there is a couple of, obviously, TCA has had been in discussion with FMA on that topic, and we have interacted on that. There are two sets of custodians, and in terms of that, supervisors and trustees themselves are custodians, and they do hold that assets. Now, they, when it comes to direct holding on some of the assets in terms of shares and equities, Guardian Trust, we don't provide that service. We appoint third-party custodians as well, but a lot of assets that we hold are held in like some units in another funds or bank accounts are held in our name, and those things are already held under the licensed custodian, as we see. But there is the third-party custodian that we appoint. So there is, in a way, the way we see it is the two sets of custodians, the third-party custodians and the custodians that the licensed supervisors already are and perform these duties.
I'd agree with Harry on that. In many cases, as a supervisor or trustee, we would hold assets like property, etc., for property trusts or for mortgage funds, etc. In custody. So when I talk about custodial licensing, I'm talking about more of the traditional, custody role.
Okay, and just our last audience question for now. Currently, there is a perception that the investor public don't know who supervisors are, or they're even aware if supervisors exist. What can supervisors or the industry do to increase awareness of the investor?
Yeah, look, I think that's a really good call out. I think that it's a mixed bag. I think in terms of investors understanding that there are supervisors sitting behind managers, and are sitting there to work in their best interests, and so I definitely think that as a supervisor group, and in particular through the TCA, there is more that we can do to educate investors about the important role that we play, to give them greater confidence in terms of their savings and their funds, and equally too, how managers also highlight that they are supervised and the role of supervisors. So I think that there's definitely an opportunity to strengthen the work that we do in this area. It's not often that investors recognise that until they need to do something like a hardship withdrawal, or they're making further inquiries, when the markets change and bits and pieces like that. So I think it's been helpful through COVID. I think some of that messaging's become a lot more prevalent, particularly given some of the market movements that happened at that time, but there's still a lot more that we can do.
I agree with Glenys. I think, and as a TCA, as a body that represents the supervisors, can do a lot more in terms of engaging with all stakeholders and within the industry, FMA managers, and other participants to promote and to basically explain the model and how everything fits together. Because you're right, Penny, and the question is on point. Not a lot of people actually understand, not just investors themselves, but if you go outside of industry, it's not really clear, where the supervisors sit and what role and duties.
What role?
I think we can do a lot more in educating the industry.
If you look at it, I mean, obviously the investors are paying a fee for us. And we are mentioned on the disclosure statements or disclosure documents, etc. But it really is something that needs to be much more highlighted, that there is that role there, and this is what you're paying for, and this is what you can expect from the supervisor as your representative.
Okay, so if we look back now, if we look to the old Securities Act regime, we can see that the role of the trustee and now the supervisor has changed. We've had the introduction of the FMCA, we've also had the Financial Market Supervisors Act, and more recently the increasing regulator focus on conduct and culture. Glenys, how do you think the role of supervisor has changed?
Look, I think it's changed quite significantly, particularly in recent times. Like you said, following the introduction of FMSA, followed by FMCA, that's meant that the supervisor's responsibilities have increased, particularly compared to the corporate trustees of old. And look, increased probably in a good way. I think there's a lot more clarity in terms of the role of the supervisor and what's expected and obligations. And so, that translates into, these days supervisors are expected to be more regularly engaged with managers, particularly focused around conduct, culture, and ensuring that customer outcomes are being met. And that's really evolved into becoming more like that frontline regulator. So we talked a bit before about the roles that the supervisor's doing in between the manager and the FMA. And since the introduction of the FMCA, the industry really has been focused on getting familiar with those regulations. So the supervisor's role has predominantly been helping supervised managers understand the practical applications of that new act. And now that the industry is more mature, what you're starting to see is a bit of a shift where supervisors focused is now working more towards improvements and best practices in these areas, particularly around conduct, and ensuring that that's inherently built into the way that managers operate, not just as a thing that they need to think about separately to everything else. It's incorporated, and it's now becoming part of their thinking and way of working. I think supervisors now too, there's been a lot of talk, and it came up in the latest FMA Insights report, are moving into much more of a proactive risk-based approach to supervision, where, in some circumstances there'll be greater interaction with managers as and when required in key risk areas. And this is a real shift in terms of what potentially was there before, which might have been more desk-based reporting or checking, to really working with managers around certain themes, and doing thematic reviews based on key areas that are going to probably add the most value to that particular manager. So it's not the same review for everybody. It's this particular review for this particular manager, because that might be a key area that they can really lift, or they would benefit from in terms of strengthening their business, their risk, or their processes, particularly to support scheme. I would just say that I think supervisors have become much more agile and nimble in terms of responding to and resolving issues. And I think we've seen that particularly over this year with COVID-19, and the importance for supervisors to take different approaches to working arrangements and making sure that technology will support interactions. I think that's becoming more and more important.
Harry, what do you think the FMA expects of supervisors as the frontline supervisor?
Yeah, I think Glenys indicated and mentioned in terms of the report that FMA have published, the Insights report, and their expectations of proactive supervision. But I think FMA will also continue to expect that we as supervisors collaborate and work closer with the FMA and continue that work that we've started already doing at the start of this year and last year, in terms of identifying trends and potential risks that we see in the market as well. And not just some of those at a granular level, but also some of those at a more holistic level. Now, doing that will enable FMA to start focusing in an area and key risks within the sectors that they can then do more monitoring or do more thematic reviews and undertake further assessment. I think Rob Everett has mentioned today that people don't intentionally make mistakes, and that entities need to have a robust processes and controls in place to prevent mistakes and put customers first, right? I think supervisors are well placed to independently assess those operations of the supervised entity and robustness of those controls and the processes and procedures to achieve those customer outcomes. Now, we will work with the manager to try and prevent those mistakes and errors, but also when those mistakes and errors occur, we work closely with the managers to ensure that customers are fairly remediated in a timely manner as well. So I think that's the work, and that's the area of that proactive supervision that sometimes doesn't come at that holistic level, but we go to that detail and also try to prevent those errors. But also when the errors do occur, we do work with the managers to make sure that good customers' outcomes are achieved.
And Ryan, what's your perspective on the changes to the supervisor's role?
Good question. I wasn't here in New Zealand during the prior regime, but you know, I've definitely noticed in the 2.5 years I've been here that there has been some old remnants, but some really positive changes in the way the supervision role works. And I think both Glenys and Harry have really have spoken about this concept of the proactive risk-based supervision, which has been to me a really important part of how a supervisor should work, and particularly being proactive, communicating, and basing a lot of our work on risk assessments and so forth. And we have been working very closely, and I see the continuing building of the relationship between the supervisors and the FMA as being a very positive thing, and all parties being really well engaged on that. So some of the stuff that the industry has been doing lately, and we mentioned before, we've done a sort of a risk thematic across the MIS industry. We're going to be doing a number of other thematic reviews over the course of the next year. To me, that just is spelling out maturity and the continuing maturity of the supervisor market. And that's something that we're really keen on continuing to work towards. And as the other two have mentioned as well, doing a lot of that work through and in conjunction with the TCA has been positive. So, in my opinion, like I said, as much as I didn't see the previous regime, I definitely see that there's really fantastic engagement happening with providers and also with the regulator.
So if we look forward now to what's next, I'd like to ask each of our panelists to tell us what they think we'll be seeing from supervisors in the next 3 to 5 years. Harry, perhaps you can kick us off.
Yeah, thank you, Penny. We started and we talked about differences to other jurisdictions, and we agreed that New Zealand model is unique, a model in the world, and but I believe that there is no reason why it can't be one of the best models in the world. I mean, if we look at, going forward, supervisors are likely to develop even closer working relationships and better understanding of the processes and controls that our supervised entities have in place. But also, it's important to know that we do have those separate obligations and duties to investors in each of those schemes and each of those products. So we get to such a granular and detailed level that we ensure that focus of the managers is on achieving the best outcomes for the scheme participants within their schemes and those products. In doing so, we developed and we already delivered that proactive supervision. The supervisors get involved in transactions before they occur. We get involved in SIPO updates before they take place. We get involved in purchases and sales of material assets. We get involved in related party transactions, all of those things before they take place. And we undertake an assessment with that proactive and with a with a view through investors' lens, and ensuring that that the best outcomes are achieved. But I do think that we will see supervisors continue to work closely with managers, but at the same time also continue to develop industry risk moderated assessment that will also enable FMA in performing their duties and looking at a targeted thematic assessments of the risks within a sector.
I also think the supervisor role is changing, apart from monitoring the products that are out there at the moment. I think we will make a big part in terms of our opinion and input, and even lobbying on the next stage of products that need to come into the market, into a maturing market. And if you look where we are at the moment, I mean, there's some great products out there, but they're all very, there's a lot of them that are very similar to each other. And I think we need to start bringing in, different products into a maturing market, particularly even from a KiwiSaver space. So, working with the regulators, working with the government, and continuing to lobby and influence, to be able to continue to meet the expectations, not only now but in the future, of the investors out there, to make sure that they've got the products that they need, not only now but into the future. And I think that's something we can really do. And another thing that has been a big focus during this conference, and also in some of the research that has been funded through the FSC, is around the education role that's needed within the industry for investors. And I think that's something also, as supervisors, we can be pushing and encouraging managers to do, is continuing to work on that education role for investors about how they should be investing, and in turbulent times, giving some guidance as to what should happen during these times. And we've seen some of the issues that have happened around KiwiSaver switching and so forth, and those things can be avoided if there was the right education out there. So I think the supervisors play a key role in looking after the investors' best interests. So therefore, we should play a key role in making sure that the education happens. So I think there's going to be a continuing focus on those future state products and future state needs for investors.
And Glenys, what are your thoughts on this?
Yeah, no, look, I would reinforce what Harry and Ryan have talked about in terms of what's on the horizon. Probably what I'd add is I think that there is a lot of emphasis on supervisors, in our efforts to ensure we're creating value for investors, just to think about how we are streamlining and ensuring consistency of our processes and the way we work. I think that there's benefit for that for us, both with the managers, so that that they don't see that as so much of a I won't say an overhead so much, but wherever we can make that more simpler and get closer to the business, so that the quality comes from the conversation rather than some of the process. I think that's how it can evolve. And as part of the TCA, I think supervisors are committed to working more closely to promote greater consistency of the supervision work and how we assess risk and what are some of the common things that come up in the industry. And I think that would give managers reassurance around that consistency, but equally too for investors. Yeah, and I think look, there's a lot of things that we don't know yet in terms of, we've seen how something like a pandemic can quickly influence investors and shift mindsets and the like. And so I think that, supervisors need to be, very flexible and open to making sure that we are seeing how investor behaviour might change or shift in terms of some of these outside or external influences, and what does that mean in terms of the work that we do with managers. And to what Ryan was talking about, I do think that education and literacy is a key piece. We saw a lot of movement and switching between funds as a result of the pandemic, and that necessarily wasn't great for investors. And certainly managers have been doing a lot of work to try and educate their investors as a result of that. But I think that there's much more that we can do as supervisors, particularly in the future, around influencing that at a broader level and at more of an industry industry piece. So that's all I'd really add.
Yeah, I agree. I think that is the point that Ryan and Glenys made. I think the supervisors will develop to become trusted advisors for managers, because we will see what is happening in the market. We will have to lift the standards across investments, operations, and everything, that all the duties that supervisors are having, that managers are having, and performance of their duties. So they should use us as trusted advisors before those transactions and before new products are brought to the market. I think lifting the standards across the industry, and whether it's operational excellence or whether it's investment, it will build and help to build the trust and confidence in the development of the financial markets, that all participants will benefit.
Just to follow on from that, I mean, the work that we've been doing together through the TCA on the thematics, it's been great, because not only can we compare one client to another client within the same supervisor, but now we have the whole echelon of all the managers, say, across the MIS sector, to be able to do those types of comparisons on risk and so forth, and we can understand outliers, and we can understand the differences in different funds and how they operate, and really from a risk management perspective, that benefits the investors to be able to look at people or look at managers that are very much outlining standard practices. So working together more effectively is something that something that's really positive, but it's something that will continue on. And there's a number of these other thematics and areas where we can lobby together to make a real difference.
Yeah, and I think that probably one other area that we haven't touched on, but in our role as supervisors and under the guise of the TCA, I think that there is, whilst most of the time I think there's really clear delineation between the role of the supervisor and FMA as a regulator, there's a small percentage of the time where actually still for managers and therefore for investors is, well, what are the different roles and what do they play, and getting real clarity around the consistency of supervision standards and ensuring that it's really clear, particularly for managers. I know that, I acknowledge that sometimes they get frustrated around, well, hold on, the supervisor is asking me for this information and so is the FMA, and what is the role that each is playing, and all the rest of it. And I think that, recognising that we all have limited resources in terms of what we're trying to do ultimately for the end investor, is that, if we can get alignment in terms of, in greater clarity in times of where there's that small percentage of time where it's perhaps not as clear as what people would hope, then that's just going to free up more time for managers and supervisors and the FMA to spend on improving the markets as a whole. So I think that there's an opportunity for us there as we move forward. And I think that comes with maturity too over time. So, that's something that I think would benefit all of the industry.
Great, thank you. So we have a couple of further audience questions coming in now, and please keep them coming. We've got about another 10 minutes, so please feel free to submit your questions. For the panelists, what do each of you think are the key risks facing scheme participants in the near future in MIS and KiwiSaver schemes that you'll be focusing on exploring with managers?
I could start. I think with the markets and what currently we are seeing with the nature of investments and with the low interest rates, I think ultimately the managers will look at yields and returns and how they can deliver those. And I think we need to be mindful of the liquidity in the market as well. And then the way as we go down down the yield curve and the managers invest in those assets, that the credit quality is still there and it does not affect liquidity, because if liquidity is affected, I think it could be a big issue, and particularly for a product like a KiwiSaver that it is a savings product, but it is a product that investors can switch from one provider to another. It is a mobile. So I think for me, it's watching that liquidity. And I think I would say that thematic that FMA is doing around that is timely as well. And it'd be good to understand what kind of processes and controls there are in place to address something like that going forward.
I think with that same thought on you're talking about yields and returns, Harry, and liquidity. I think one of the things that to me has been on my mind is what other types of asset classes will be starting to be put into funds or considered to be put into funds that have not traditionally otherwise been there. And to me, that's something that I'd like to be paying a lot of attention to, is understanding what else apart from your standard asset classes that are going to start we're going to start seeing in some funds. I think also there's the review on and the thematic of conduct and culture is not anywhere near over, and I think that's something that's going to continue to be a really big push over the course of the next 12 months to 2 years or so. Particularly from what we've learned from the Australia Royal Commission is we really need to change people's mindsets, and that's not something that really happens over the course of 6 months or 12 months, but it's something that's going to be an ongoing change that needs to happen to the industry.
Yeah, and I would echo. I think with Harry and Ryan, I think they're right on the money in terms of where those key risks lay at the moment, and in particular in the environment that we're in. When you think about culture and conduct, is that it becomes even more important in the context of the type of environment that we're in. So I would echo what they've said.
On top of, sorry, I was going to say, on top of that, I mean, one of the things that's, I'm really keen on, we've spoken about before, is we look at mostly from a supervision perspective, the retail funds, but I know there's an expectation from the FMA really to be looking down to the source assets being invested in. And that means a much higher focus from the supervisors on wholesale and wholesale funds too, that the retail funds are investing in, and getting a view of really the drill down on the performance and yield over all of the investments that make up a fund.
So on a no names basis, can you please give us an example of when you've experienced a tension in the relationship with a supervised entity, when your recommendation was not popular with the manager? How did you and the manager handle it?
I think a robust conversation is something that really does need to take place, and people have their own opinions on what should happen, and I definitely know our supervision team don't discourage those conversations. In fact, they encourage them, and we'd prefer to understand someone's opinion rather than sit there and us tell them something that they don't believe is right. And we do have some clients or some relationships where we do get to loggerheads, and that's just a matter of sitting down and having a good robust conversation about how the things should operate. But ultimately it does come back down to what is the law. And there's a lot of conversations, you need to have, about that, coming back down to the interpretation of the legislation, and that's maybe when legal opinions need to start coming to it.
Yeah, I think that, if I think about scenarios where there's been that tension, I think that a lot of it comes from, taking a different perspective. And if we can align around, okay, how might this be viewed through the eyes of the investor? And did the right thing happen by the investor? that often can be a point where, you know, some compromise or some alignment can happen. I mean, ultimately, you know, there is often some different drivers for managers and different perspectives. But I think that, you know, to what Ryan said, I think that there's a lot of discussion that goes on. There's a lot of listening. So I think it's very much a share and listen. So share opinion, listen, share and get feedback. I mean, ultimately, at the end of the day, as a supervisor, we will have a view or we'll need to make a call. And you know, in very serious situations, you know, that's reported to the regulator and the regulator will have a view. And ultimately it's the regulator that will enforce if they don't think that if there's remedial action that's required and it hasn't happened. Then I suppose that's the risk that's run if a manager and supervisor can't find that middle ground, is actually, well, there is an independent regulator that equally can come over the top and see it quite differently. And so I think there's a lot of discussion that happens across all of those three parties when certain tensions do arise. But I suppose I always try to sit back and encourage, look, actually through the lens of the investor and everything that we're trying to achieve in financial markets at the moment, is the right outcome being achieved? And usually I think for managers, you know, sometimes it can be a bit of a journey to get there because of that shift, because they don't go out to mislead investors. They genuinely try to do the right thing, but sometimes that doesn't always occur. Or there can be a differing view from an investor's perspective. And so it's taking on board that learning and thinking about, well, how would we do that differently? Or what robust processes would we need to put in place to ensure that there might not be a discrepancy again, or the like. So, and this is the challenge, because I don't think that there's a single situation that applies to all. I think there is varying degrees of situations that supervisors and managers need to work through on a case-by-case basis. But I think the key thing is having open dialogue, sharing opinions, and then listening to that feedback and considering, always taking it through the view of the investor.
Yes, look, I would agree with what Ryan and Glenys have said. And in undertaking supervision through investors' lens, it's the most important thing, and having in mind that both the manager and supervisor have to act in the best interest of investors. I mean, we encounter that and in a couple of ways. I think that one way is obviously lifting what we talked about, lifting that standards and understanding that proactive risk-based supervision, where we go and understand the processes, controls that managers have in place and assess their robustness and if they need to be improved. And then sometimes, look, it's to say to the manager, look, you need to add 5 more controls on this. It's not an easy conversation, and the manager will go, look, what is, you know, it is adding additional cost, but it is understanding that, look, those controls are there to hopefully prevent any further errors, any further mistakes, which will ultimately benefit you and benefit investors as well. And then there is the other part of those proactive supervision that Glenys has mentioned and talked about, is that where we get involved in transactions that haven't taken place and have to exercise discretion, and then we have to turn our mind to assessment, what's the outcome. And yeah, the managers 9 out of 10, they have thought about this thing through, and they have run through their internal due diligence process, and their directors have made assessments. But sometimes we do need to ask more questions and get satisfied that when they're exercising their discretion, that all of the key components have been taken into account, because sometimes those transactions have to happen quite fast in the market if there are opportunities, but we are there to ensure that they have been considered robustly, and that robust assessments and due diligence has been undertaken by the manager to demonstrate that they are in the interest of investors and comply with the terms of the offer.
Well, look, unfortunately, we're out of time now. Thank you, everyone, for attending this afternoon and for actively participating with your questions. And thank you, of course, to Harry, Glenys and Ryan for a very informative and enjoyable session. I think we've all learnt more about the key role that the supervisor plays and how it may develop in the near future. If you'd like to listen to this discussion again, it will be available through FSC for on-demand viewing by the end of today. Thank you again, and we'll see you back online tomorrow for more conference sessions.
Thank you.
What a fantastic, engaging audience you've all been. It's hard not to get involved with the discussion with so many great speakers sharing their wisdom on such important topics for the sector. We hope that you've found the day as interesting and as valuable as we have. As we bring day 2 to a close, take time to absorb the knowledge from today and rest up for another huge day tomorrow. This conference is going to end on a high note. We look forward to seeing you back here rested and rejuvenated for what looks to be a stellar cast of speakers and panellists. Bring your breakfast, grab a coffee and sit tight. Once again, if you have any questions about the event, please email events@fsc.org.nz and the events team will be in touch. I'm Kirsten Young, Regional Manager, Astron Life, and I've been your MC for day 2. I've thoroughly enjoyed sharing the show with you today, and I look forward to joining the virtual audience tomorrow. Thank you to the team here in the studio, and have a good night. E noho rā.